Imagine a financial system where massive banks quietly move millions of ounces of precious metal, while ordinary investors are pushed to the sidelines without realizing it. No breaking alerts, no dramatic headlines, just balance sheets shifting and power consolidating. Today's story centers on a live tug-of-war inside the global silver market. Deutsche Bank is forced to deliver 3 million ounces of physical silver. At the same time, JPMorgan absorbs nearly 80% of that metal. And somewhere in between, retail investors, the so-called silver eagles, disappear from the picture. This isn't about conspiracy or panic. It's about how modern financial markets actually work when pressure builds. What does forced delivery really mean? Why do the biggest banks end up with the metal? And why does this matter to anyone who isn't a trader? Let's break it down, step by step. Silver trading looks simple on the surface, but the reality underneath is far more complex and far more revealing when stress appears. Most people assume that when silver is traded, actual metal is moving from one owner to another. In truth, the vast majority of silver transactions never involve physical silver at all. What changes hands instead are contracts, promises, and obligations recorded on screens. This paper-based system works smoothly as long as everyone agrees not to ask for the metal at the same time. Here is the hook most viewers miss. The silver market is built on the assumption that delivery is the exception, not the rule. Futures contracts allow buyers and sellers to lock in prices for a later date. In theory, these contracts can end with physical delivery. In practice, more than 90% are closed out with cash before that day ever arrives. The system relies on rotation, not redemption. As long as contracts are rolled forward, everything appears liquid and stable. This creates two parallel markets that look connected but behave very differently. The paper market is fast, deep, and highly leveraged. Large volumes can be traded instantly with relatively little capital. The physical market is slow, constrained, and logistical. It involves vaults, transport, insurance, and verification. When conditions are calm, paper prices guide the entire market. When pressure rises, physical availability begins to matter more than quoted prices. Large banks sit at the center of this structure. They act as market makers, meaning they provide liquidity by always being ready to buy or sell. They also operate vaults, manage storage for exchanges, and finance metal flows. This gives them a unique advantage. They can operate comfortably in both the paper and physical worlds. Retail participants, by contrast, usually operate in only one. They buy small physical products like coins, or they trade paper exposure through funds and derivatives. Another critical detail is inventory visibility. Exchange inventories are reported regularly, but these numbers can be misleading. Much of the metal is already spoken for, leased, or pledged as collateral. What looks like available supply on paper may not be freely accessible in practice. This is why delivery events matter so much. They force clarity. Someone must produce metal, not a promise. When delivery demand rises, the character of the market changes. Participants who are comfortable trading paper exposure suddenly face a different question. Do you actually have the silver? For institutions that planned ahead, this is manageable. For others, it becomes a problem. This is where forced deliveries emerge, not as accidents, but as outcomes of structural design. There is also a psychological layer. Paper markets are built on confidence. As long as participants believe delivery will remain rare, leverage expands and volume grows. When confidence weakens even slightly, behavior shifts. More buyers choose delivery. Sellers become cautious. Inventories draw down. The system doesn't break immediately, but it tightens. Historically, this tension has appeared many times. During periods of financial stress, physical metal often trades at premiums to paper prices. This gap isn't irrational. It reflects different risks. Paper prices reflect expectations. Physical prices reflect availability. When those diverge, it's a signal that the market's internal balance is shifting. The key insight is this. Silver markets are not designed for mass physical withdrawal. They are designed for efficiency under normal conditions. When something forces the question of delivery, power flows toward those with infrastructure, capital, and patience. Understanding that structure explains why certain players always seem to emerge stronger when pressure builds, and why others quietly exit without ever making headlines. When people hear the phrase forced delivery, it often sounds dramatic, even alarming, but in reality it is one of the clearest stress signals a financial market can send. In futures markets, most contracts never result in metal changing hands. They are rolled over, offset, or settled in cash long before delivery day arrives. The entire system is built on that assumption. So when delivery is demanded and cannot be avoided, it immediately raises a different question. Why does someone want the metal now, not the money later? A forced delivery means the seller no longer has flexibility. At contract expiration, obligations become physical, not theoretical. 3 million ounces is not symbolic. It requires vault space, logistics coordination, insurance, and verified inventory. That alone narrows the field of participants to only the largest institutions. The hook here is simple but powerful. Delivery exposes who actually controls supply, not who trades the most paper. These events tend to surface when confidence tightens. It may be concerns about future availability, distrust in paper claims, or strategic accumulation by buyers who see value beyond price. Forced delivery doesn't shout. It whispers. But markets listen closely. It signals that at least one participant believes physical ownership matters more than cash settlement. And when that belief spreads, even quietly, it can change behavior across the entire system without a single headline ever explaining why. When a single institution absorbs the majority of a large physical delivery, the significance goes far beyond the headline number. Taking control of 80% of a multi-million-ounce silver transfer is not a trade designed for short-term gain. It is a strategic move rooted in influence, access, and timing. Large banks operate in a different dimension of the market, where control over inventory can be more valuable than price movements themselves. The hook is this: ownership changes power long before it changes price. Physical silver confers optionality. It can be delivered, leased, pledged, or withheld, depending on market conditions. An institution with deep vault capacity and global logistics gains flexibility that paper positions cannot replicate. This matters most during periods of stress, when supply becomes fragmented and certainty carries a premium. By securing such a dominant share, a bank reduces exposure to shortages while quietly increasing leverage over future settlements. There is also a signaling effect, even when unintentional. Market participants who track inventory flows understand that large accumulations rarely happen by accident. They suggest foresight rather than reaction. Importantly, these moves are often executed in a way that avoids price disruption, precisely because stability benefits the largest players. The result is a paradox that catches many observers off guard. The market appears calm on the surface, while control beneath it becomes increasingly concentrated in fewer hands. Retail investors often assume they are participating in the same marketplace as major institutions, watching the same prices and responding to the same signals. In practice, they operate on very different terrain. When pressure builds around physical delivery, the rules shift quickly, and those shifts rarely favor smaller participants. The hook is uncomfortable but important. Most retail investors don't exit the market by choice. They are quietly removed by its structure. As volatility rises, exchanges adjust risk controls. Margin requirements increase, meaning traders must post more capital to maintain positions. Liquidity thins, bid-ask spreads widen, and automated systems begin closing positions that no longer meet strict thresholds. For large banks, this is manageable. For individuals, it often isn't. Positions are reduced or liquidated not because a view was wrong, but because the cost of staying in the trade suddenly changed. Physical delivery amplifies this divide. Retail investors typically lack access to approved vaults, transportation, and compliance frameworks required for large-scale settlement. Even those who want delivery usually cannot take it. As a result, When the market pivots toward physical control, retail participation fades from view. The disappearance isn't dramatic. There are no announcements, just fewer small players left standing as the arena narrows to those built to operate within it. Financial markets have a long memory, even when participants believe conditions are new. Moments like this echo earlier episodes when paper confidence collided with physical reality. In the late 1970s, silver markets experienced extreme strain as concentrated positions and rising demand pushed the system toward its limits. Prices moved violently, but the deeper lesson was about structure. When delivery became unavoidable, the market revealed who had access to metal and who only had claims. The hook here is that history rarely warns loudly, it repeats quietly until pressure forces recognition. Similar patterns appeared during the global financial crisis of 2008. Gold markets remained open, prices fluctuated, yet physical availability tightened in unexpected ways. Coins and bars vanished from retail shelves even as quoted prices suggested normal conditions. The disconnect confused many observers, but insiders understood the signal. Physical demand was expressing distrust in paper promises, even as official systems maintained an appearance of order. Each episode shared a common thread. When uncertainty rises, participants with foresight prioritize control over settlement risk. Large institutions that secured physical assets early gained flexibility and resilience. Smaller participants learned that liquidity can disappear faster than prices adjust. These moments did not end markets, but they reshaped behavior long after volatility faded, leaving behind structures designed to withstand the next test. One of the most confusing aspects for observers is the absence of an immediate price reaction. Intuition suggests that when supply tightens and demand intensifies, prices should surge. Yet in many cases, especially involving large institutions, the opposite happens. Prices remain stable, even subdued. The hook lies in this contradiction. Markets can look calm precisely when they are under the most strain. Major financial players have strong incentives to avoid sudden price moves. Sharp spikes attract attention, invite regulatory scrutiny, and disrupt long-term strategies. Instead, accumulation often occurs quietly, through negotiated transfers and controlled settlements. By spreading activity over time and across venues, large participants can absorb significant quantities of metal without triggering visible alarms. Price, in this context, becomes a delayed indicator rather than a real-time signal. Inventory movement tells a more immediate story, but it is far less visible to the public. Vault reports, delivery notices, and warehouse flows reveal shifts that charts may hide. For most viewers, this creates a false sense of normality. The screen shows stability, while the system adjusts behind it. This dynamic explains why major changes often seem obvious only in hindsight. By the time prices react, positions are already established, and supply chains are already tighter. What appears to be a sudden move is often the final act of a process that began quietly, well out of view. The broader implications of these movements extend far beyond any single trade or bank. What happens in the silver market is not isolated, it ripples through supply chains, industrial production, and investor behavior globally. The hook is this: even events that appear contained have the power to reveal the hidden architecture of the economy. When a few institutions control the majority of physical metal, it exposes the leverage and vulnerabilities built into systems most people take for granted. Industries that rely on silver, electronics, solar energy, medical devices, can experience delayed production or increased costs without a single headline reporting it. Manufacturers may scramble to secure alternative sources, sometimes paying premiums, while smaller investors are left to react rather than act. This disparity demonstrates how control over tangible assets translates into influence over wider economic outcomes. Governments and policymakers also take notice. Concentration of supply can trigger strategic planning, reserve assessments, and regulatory oversight. Decisions made in corporate boardrooms, often invisible to the public, can shape market expectations and resource allocation for months or even years. The underlying lesson is that modern financial systems are interconnected and layered. Even small disruptions, when handled quietly, reveal structural fragilities and force adjustments across multiple sectors, showing how power and access in financial markets dictate outcomes far beyond the immediate transaction. Let's recap. A major bank delivers millions of ounces of silver. Another absorbs most of it. Retail investors fade from view, not because they failed, but because the market shifted. Beneath them. This isn't drama, it's mechanics. If you want more calm, clear explanations of how global finance actually works, without hype or fear, like the video. Leave a comment with your thoughts and subscribe to the channel, because understanding the system is always more powerful than reacting to it.